welcome everyone. Just wanted to remind everyone that there are question and answer available in the top left box of your screen. We'll be taking those at the end of the call, but for now I will hand it over to Darren Sharinga, who will head into the presentation. So, Darren.
Thank you, Will. Good morning and welcome to our quarterly webinar, and this one entitled Distribution Growth, the Key to MLP Investing. Joining me on the call today is Jim Hugg and Will Hershey, who you met earlier or introduced to me. The key to MLP investing, distribution growth. Distribution growth, in Yorkville's opinion, underpins the investment thesis for MLPs. It has always been a primary attribute that we're looking for in an investment of an MLP partnership, and really is a best-of-breed investment. There are two criteria that we have. Number one, invest in partnerships that have a very low probability of cutting their distribution, and two, invest in partnerships that have clearly identifiable catalysts for future distribution growth. You look at distribution growth as the fundamental for the MLP investment thesis because it touches every aspect of the total return equation. And we deconstructed total returns here graphically to illustrate our point. And this formula works for any type of total return. Your total return is current income plus growth of income plus price appreciation equals your total return. And if you look at income touches, or in growth of income specifically, touches all aspects, all three aspects of total return. Your income drives, the magnitude of income drives the level of current income we're receiving from the investment. The growth in income it provides a number of benefits to the MLP investment thesis. It's protection against rising interest rates. It's a hedge against inflation. It's what makes MLPs unique relative to fixed income investments, the fact that they offer growth of income like equities, and this growth of income like equities, growth again, powers price appreciation. And so you had current income plus growth in income plus price appreciation equals the total return of the investment. If we attempted to quantify this, distribution growth matters to MLPs. And what we looked at, we went back to 2000 and we said, now, we knew MLPs are one of the highest yielding alternative sources of income for investors. And we also know that they have been growing their distributions historically, which varying on partnership, but let's just say between the 4 to 6% range of distribution growth. So highest income alternative asset class offering distribution growth, what percentage of total return was driven from price appreciation relative to distributions or income? And what surprised me, and us as a firm, is 61%. Over half of the returns of MLPs were derived from capital appreciation or price appreciation, and 40% from distributions or current income. And we were discussing this earlier. If you take two extremes, take growth stocks that produce no income, and you'd expect 100% of your return to come from price appreciation because you are receiving zero current income. And the reason that return is coming from price appreciation is because these companies are experiencing growth in revenue, ultimately translating into growth in cash flow from the businesses that they're engaged in. The other end of the spectrum is fixed income. When you look at fixed income, the majority of your return over time from fixed income is its fixed income is going to be derived from the amount of income you receive, and very little will be derived as part of total return over the investment horizon from your price appreciation. And so you're almost getting, and it's not quite zero. If you hold it for an entire period, I think it would be zero, wouldn't it, Jim?
Yes, absolutely.
Yeah, because you pay 100 cents, you receive 100 cents, and all that you got in the investment over that time period was income. So on the other end, you have 100% of your returns coming from distributions. Interesting to see that MLPs are more skewed towards growth, more equity-like characteristics than they are fixed income-like characteristics, with 60% of their returns over this past 13 years coming out of price appreciation, which is driven by growth in distributions. The next slide, we actually then quantified it. In probably in future slides, I will put in fixed income on one end and growth equities on the other end to make this comparison. But what this slide shows is MLPs are on the left, then REITs, and the S&P 500, so that measures equities and utilities. What was interesting is that MLPs had the most amount of growth or total return that was derived from price appreciation due to growth in distributions at 60%. REITs were next at 54% of the total return from REITs came from price appreciation. And the S&P 500, which is currently yielding approximately 2%, so a very low yield relative to almost 6% coming out of MLPs, less than half of its return over the past 13 years has come from price appreciation in spite of its low yield. And I found that very interesting when comparing it to MLPs. And then utilities, which arguably have more fixed income characteristics. You saw the majority of the returns in utilities coming out of your income relative to price appreciation. So if you look at this continuum and what would be a conclusion that one can draw from this, on the right-hand side, if you look at the MLP universe, this would be companies that are growth-driven, and on the left-hand side, these are investments that are income-driven. Using that as a range of investment alternatives from growth equities to fixed income on the left and growth equities on the right, your hedge and where you want to position yourself in a rising interest rate environment, you certainly don't want to be invested in fixed income. Because fixed income, again, with fixed income is going to trade relative to interest rates. If interest rates go up, your principal value is going to go down, so that interest rates will match the market. And so you want to avoid fixed income. You want to be more to the left-hand side here. I had my right and left backwards earlier, I see. The left-hand side towards the MLP universe and towards growth equities. That's going to give you the protection that you're looking for in a rising interest rate environment. So often the question has arisen of late because of where interest rates are, how do MLPs perform in rising interest rate environments? Well, just based on this analysis here, you've seen that MLPs offer more characteristics of growth equities based on percentage of return coming from price appreciation versus income than they share with fixed income on the right-hand side. In summary, the benefits of distribution growth: it's a hedge against inflation. It offers protection from rising interest rates. It increases the security of income, and ultimately it powers price appreciation in the investment. That's why, from Yorkville's perspective, focusing on distribution growth even above current income when we're looking for investments in the MLP asset class is so important, because by doing so, we're delivering to investors everything that they're looking for. Not only are we delivering high current income, but we're delivering high quality current income that offers a protection against rising interest rates, or important for investors moving into retirement, a hedge against inflation due to growth in distributions. There are two scores that we've created to help investors monitor the overall health, and if I really could say the macro health of MLPs, or the investment thesis underpinning MLP. So if the investment thesis is growth, you want to focus on how is the asset class growing overall. Number two, actually, and number one is what's the quality of growth? What percentage of MLPs are increasing their distributions? Because in a healthy asset class, you want to see broad-based maintenance and increase of distributions, and you also want to see rapidly growing distributions. And you don't want it skewed by one or two companies, but you want to see many companies providing this growth and driving this growth. So we publish these scores on a quarterly basis that investors can quickly see what's happening across the asset class. Our Yorkville Stability Score measures the quality of distribution growth, and a score of 10 would mean 100% of all partnerships maintained or increased their distributions in the current quarter, and a score of 0 would mean no partnerships increased or maintained their distributions. So in fact, every partnership cut their distributions, and so a score of 5 means 50% maintained or increased, and 50% cut their distributions. So as you can see from the first quarter, score of 9.6, 96% is a way of looking at that, maintained or increased their distributions in Q1 of 2014. So the Yorkville Growth Score measures the growth across the entire asset class, and we do adjust it for a couple of areas. One, we don't want it skewed by corporate actions. So if there's new companies added that do not have historical distributions, they'll be removed from the calculation. If there was a corporate action that took place that caused distributions to be inflated or deflated, we remove those from the calculations. And we also remove variable distribution MLPs, because by their very nature, they'll be moving up or down without a hedge, and that's not a true MLP investment. So we look at intrinsic growth across the asset class, stripping out for these factors, and we see that in the first quarter we had distribution growth across MLPs of 5.5%, which is in line with historical averages, near the upper end actually, between 4 to 6%. Growth rate 5.5% would be at the upper end of growth we've seen in distributions of MLPs over time. That 5.5% growth rate, again, this is the thesis that we've been talking about today. Growth matters. 5.5%, you would basically, based on the rule of 72, which you take 72 divided by your investment return. In this case, growth, or 5.5% every 13 years, basically. A little less than that, 12 and change, you'd be doubling your income. And if you simplify it and say, okay, well, if inflation historically is run at 2%, Jim, roughly?
Yeah, 2 plus.
2 plus, a little lower than that currently. And you have an asset class that's growing significantly above the rate of inflation. That's why we say it preserves the purchasing power of your assets over time. Very important for investors that are moving into retirement and looking for a way to invest in an asset class that will provide them with some type of protection and future growth. Looking at these two scores, they're published on the front page of our website at yorkvillecapital.com. Great way to get a snapshot of what's going on in the industry. If you look at the downturn of 08, because quality, again, is part of what we're looking for, invest in MLPs that are unlikely to cut their distributions. In the downturn of 08, worst financial crisis that any of us have lived through, we saw in our portfolio 100% of the names that we invested in maintained or increased their distribution. So fundamentally, we delivered what we're on our investment objective. Across the entire asset class, 75% of all MLPs maintained or increased their distribution. And that's due to the nature of the long-term contracts and very low commodity exposure or cyclical exposure of the asset class. And the overall decline in distributions was only 9% during the financial crisis of 08. If you look at your returns in the first quarter, you can see that MLPs returned 3.8% across the asset classes measured by the Yorkville MLP Universe Index, which covers 100% of all master limited partnerships, so it's the entire universe that we're tracking. They were up 3.8% for Q1. It compares favorably with the S&P 500, which was up 1.8%, and underperformed significantly REITs and utilities. And a little of that was, this is a bounce back from last year, which, again, using a proof statement or an example of a rising interest rate environment. Last year, the 10-year Treasury, U.S. Treasury, rose from 1.8% to basically 3% at the close of the year, and MLPs in 2013 were up 28.6%, in line with the S&P 500. So MLPs, rising interest rate environment, MLPs went up in value. Last year, if you look at it, REITs and utilities, REITs were up 2.7%, utilities up 13.2%. Both REITs and utilities were moving more to the right end of my curve, more towards fixed income. Less of the total return that they have exhibited historically comes from growth of distribution. So Q1 a little bit, interest rates pulled back a little bit, more interest rate sensitive stocks did better. MLPs, slow and steady, which is what we like about the asset class, continued to perform well, up 3.8%. So that's our Q1 comparison. If we look at historical returns across the asset class, and this Len isn't with us today, he's actually traveling. He loves to look at this chart. This is the power of compounding in the asset class over time. And from 2000 through the first quarter of 2014, we compared MLPs again with utilities, REITs, and the S&P 500. And MLPs have delivered 9 times your money over this period of time, which is a shocking return. The S&P 500 is basically up 1.7 times your money. So that's the power of distribution growth and the income. It's the power of high current income, and it's what MLPs have returned historically to investors. If we look at yield comparisons, this is as of 3/31/2014, the end of the first quarter, which all of our data points are touching on. MLPs, again, as measured by the Yorkville MLP Universe Index, were up, yielded 5.8%. Again, relative to REITs, which are more interest rate sensitive, you're picking up almost 200 basis points in additional income, and similarly, you are actually picking up 200 basis points over utilities. What's incredible here is that MLPs have historically offered higher quality distributions, so more stable distributions, less volatility. Again, going back to Yorkville, 100% of our names maintained or increased their distributions in the downturn of 2008, and faster growing distributions relative to these asset classes. Yet, we're still picking up almost 200 basis points premium in yield over higher risky, lower quality. And we think over time, as more investors move into the MLP space, that we'll see this spread between REITs and utilities narrow. And at some point, we would actually expect it to reverse, that you'd have a lower yield coming out of MLPs and relative to REITs and utilities. It's also a good point for investors who are sitting on the sidelines right now wondering, am I too late to MLPs given the run that we've seen? Are they overvalued? If you use income as a basis in the spread between REITs and utilities, you're still picking up 5.8% current income. So our argument would be that they're not overvalued, and on a relative basis, that is a relative comparison, but looking at quality, again, there's the opportunity for this spread compression between REITs and utilities, which we do believe will take place over the coming years. Finally, getting to what Yorkville does best is invest in MLPs. We are looking at our core income strategy through March 31st of 2014, our average yield was 4.6% relative to the MLP universe, which yielded 5.8%. So to MLPs in general, we were yielding 1.2% less. Why? For growth. And if you look at the next page, which we compare the distribution growth in our portfolio relative to the MLP Universe Index, our portfolio, the names in our portfolio exhibited distribution growth, cash on cash growth of 14.4% in the first quarter relative to the MLP universe of 6.6%. So our portfolio from a growth perspective delivered 2 times the growth that the broader MLP asset class did. Again, all of the favorable attributes of growth in the investment thesis that we mentioned before: hedge against inflation, protection against rising interest rates, powering price appreciation, and ultimately higher quality distributions, less volatile distributions. It's a wonderful position. If you look at deconstruction of total returns, you take 14.4% plus 4.6% and add them together. That's a good back-of-the-envelope way of calculating total returns, and you're looking at something that has the potential of returning high-teen type returns if we can continue to deliver this type of income and this type of distribution growth relative to the MLP universe, which has the ability of delivering low-teen type performance. That's the alpha that we look to deliver in our strategy and have delivered historically by focusing on not only quantity of distributions, but really quality and growth of distributions to drive our investment thesis, and view the MLP asset classes as a total return story, not simply as an income story. And we think as investors become more and more knowledgeable about MLPs and the power that they possess to continue to grow their distributions over time, that investors will embrace the growth story behind the asset class. Our strategy returns. So does growth pay? And I'm not saying every quarter it's going to pay. It's not. It's going to pay over long cycles. But in this first quarter, we were fortunate enough, and last year we were fortunate enough to demonstrate over those periods of time that our strategy did pay off. We delivered alpha. The MLP universe, as I mentioned earlier, was up 3.8%. We were up 7%, not quite 2 times the return, but pretty close. And last year, to remind you, our flagship strategy, the MLP Core Income strategy, was up over 58% relative to 28% for the benchmark. So we did double the performance of the benchmark last year. Our goal isn't to double. Our goal is strictly, we're looking at company by company, strong fundamentals, and again, I just want to reinforce it. Finding MLPs that have a very low probability of cutting their distributions and clearly identifiable catalysts for future distribution growth. And if we continue to apply a methodology that we've been using over the past 20 years as pioneers of investing in this asset class, we believe our repeatable process should lead to returns that we're proud of and that our investors are happy with on an absolute basis. The attribution analysis, I'm going to go over this quickly. I'd rather do this offline with people, investors or potential investors. Energy services, general partners, these are 2 sectors of the asset class, drove a lot of our returns in the first quarter. Almost 5% came from these 2 sectors. And the E&P, exploration and production, gathering and processing, both cost us a little bit of money, but broadly speaking, most of the names in the portfolio were up on the quarter. We had a couple of down names, and the down names were E&P and gathering and processing. So finally, our recent returns, we've, in this final bar chart, looks at month-to-date numbers, year-to-date numbers, and more importantly, 3-year numbers, a little longer time horizon. Over the past 3 years, we've delivered annualized performance of 29%, close to 30%, versus our MLP universe and the S&P 500, which are basically neck and neck at at 14, so half that number. We're not saying we're going to deliver 29% going forward per annum. We sort of discussed what we think the power of the portfolio is at, and we are very grateful for our investor support. We are encourage anyone who's thinking of the asset class to look at Yorkville and consider us as a manager, and we'd love to have the opportunity to talk to you about what MLPs will do to a portfolio when adding them in, not only to income, but to risk and returns, how it affects the efficient frontier, and what we do differently than others. Hopefully it's been somewhat spelled out here. We're focused on total returns. We're focused on the quality of distributions and on growth of distributions. So that concludes my formal remarks. I am going to open it up to questions at this point. If there are any questions, if there are no questions, I encourage investors to either go to our website at www.yorkvillecapital.com. We publish a ton of good research on the asset class that is free of charge, and I also encourage you to call in to speak with one of us in person, and we can be reached at 212-755-1970 is our direct number here in New York City. So I will open it up if there are any questions.
So if you have a question, just feel free to type it into the box in the top left corner of your screen. I see that we have one question here, and I think we'll ask Jim on this one. Given your experience in the space, can MLPs be owned in retirement accounts?
I think in every research report that you get, there's a caveat in bold letters and which says that, you know, to talk to your accountant about it. I guess the short answer is it's a little tricky, and because you face what they call, without getting too detailed about this, UBTI, unrelated business tax income. So I can just tell you that you know, the retirement accounts that we manage do have MLPs in them. We have never, and I've been investing for quite some time, and I've never experienced any problem with and facing UBTI. But again, we suggest that you check with your accountant.
Thanks, Jim.
And if I was going to add to that, I think that we were recently presenting at a MLP conference hosted by Capital Link here in New York. And that question was asked of PwC as well at the conference, and their answer was there's nothing. Yes, MLPs can be invested in IRAs. There's nothing precluding an investor from doing so. If there's any UBIT, which is unrelated business taxable income, which produces unrelated business income tax, that would be paid by the custodian of the account. And so, again, it's definitely a viable option. And the only question is if there's any UBIT that is generated, that would then be paid by the custodian. So again, consult with your tax experts, but our understanding of it is that nothing precludes investors from putting MLPs into their portfolio. I think that's it for today. We appreciate everyone's loyalty and support. We look forward to you joining us on our next conference call at in 3 months' time from now, and we'll discuss second quarter results. And on that, we wish everyone a good day. Thank you.